We're now going to look at chapter 22, and we're going to look at the variances for the factory overhead. So you understand factory overhead is broken into two types of cost. I have fixed cost and I have variable cost. And I actually have to be very careful here. So I actually have a report on the next page that shows me my overhead cost budget. Now, at the top up here, you're going to see percent of normal capacity. So we talked about normal capacity. Normal capacity is always 100%. And so I'm going to be looking at the figures in this column here. So here's the number of units I produce, my direct labor hours, and that's based upon 0.80 per hour per unit. So example, if I'm doing 5,000 units times 0.80, my direct labor hours are 4,000. Over here at 100%, if I'm producing 6,250 units times 0.80, my direct labor hours are 5,000. So down here, if you notice, I have my cost, my factory overhead are broken into variable and fixed. And here's examples of variable factory wages, which is indirect labor, indirect materials, and power and lights. Obviously, they're variable because the more I run the factory, the more power and lights I need, the more indirect labor I have, the more indirect materials I have. And so these costs are given to me as variable costs. And here are my total variable costs. Here are my fixed costs. So no matter what happens, no matter what quantity, my fixed cost will be the same. Look, supervisor's salary, it's the same every month regardless of the quantity or the capacity I'm running at. Depreciation, insurance, these are all fixed costs that remain the same regardless of the percent or the units I'm producing. So remember, going back to my factory overhead rate, I'm going to take my total factory overhead cost of $30,000. We're going to look at it at 100% capacity. $30,000 divided by 5,000 direct labor hours. This is what I'm estimating using. So my factory overhead rate is $6 an hour. And that's going to be for both fixed and variable. But we're going to break it apart so we can actually figure out how much is fixed and how much is variable. So here's how this is my budgeted factory overhead at $6 per direct labor hour. And so we're going to use the same formula like this up here to calculate the rate for my variable and the rate for my fixed. So here's calculating my rates for my variable. So if you go back and look, $18,000, and this is at budgeted variable overhead at normal capacity. Normal capacity is always 100%, divided by normal productivity capacity. That's my 5,000 direct labor hours. So my variable overhead rate is $360, and my fixed is $240. When I add them together, they will be the $6, which is my total factory overhead rate. So you're not always going to know the total factory overhead rate. You might know the variable and you might know the total factory, then you can figure out the fixed rate. So you may know two of these three and it'll be able to allow you to figure out what is the third one. So the first thing we're going to look at is variable factory overhead. So we're going to look at variable. So the key word is whenever you hear the word controllable, it's a variable cost. And here's my formula. Actual variable factory overhead minus the budgeted. Now, we're going to talk about this in a minute, but here's what my variable factory overhead controllable variance equals is the actual minus the budgeted. But the budgeted is the problem you're going to have. Actual, you'll always know. And again, if actual is less than budgeted, then it's a favorable. And you remember that's going to be a negative number. If actual is more than budgeted, it's going to be unfavorable and it's going to be a positive number. So you already know actual factory overhead. So here's the budgeted. Here's how to calculate the budgeted variable factory overhead. Standard hours for actual units produced times my variable factory overhead rate. So let's take a look on the next slide. So here's my budget. I'm going to do my budgeted first. So this is for 5,000 jeans. And if you go back and look at that, you'll find out when I'm making 5,000 jeans that 4,000 is my direct labor hours. So those are my standard hours for the 5,000 produced times the rate of 360. So my budgeted variable factory overhead is 14,400. Okay, here are my actual factory overhead costs, again broken down into variable and fixed. So if this is my budgeted and this is my fixed, down here my variable factory overhead variance is negative 4,000, which means it's favorable. So my actual was 10,400. I budgeted for 14,400. I ended up actually having not spending as much as I thought. That's always a favorable number and it will always be negative. And that's a good thing. Now we're going to look at the fixed factory overhead. The key word here is volume variance. When you hear the word volume, it's fixed factory overhead. Here is the formula. It's kind of intense. So the fixed factory overhead volume variance, hold on, let me get my little clicker here. Okay, is, then pay attention to the parentheses. Standard hours for 100% of normal capacity minus standard hours for actual units produced times my fixed factory overhead rate. So this is the formula to calculate the fixed. So as you can see here on this slide, again, unfavorable happens when my actual units produced is less than 100% normal capacity. Favorable is when I produce more than 100% capacity. So let's take a look at the slide here. So here's my formula for fixed factory overhead. So my standard hours for 100% of normal capacity was 5,000, but for making 5,000 units, I only used 4,000 times 240. So I actually have an unfavorable variance because of the fact is that I used my, I'm sorry, let me say this again, that my actually standard hours were less for the actual units produced. So I'm unfavorable. So this is kind of confusing here. This is probably the hardest part, I think, of the whole thing here. Okay, so this little slide is just a little graph showing you different things. The unfavorable volume means fixed. So just take a look at this and let's move on. So now we have our factory overhead variances. My variable was negative 4,000, which was favorable. My fixed was positive 2,400, which was unfavorable. But my overall cost variances, again, variable and fixed are added together. My overhead cost variances is favorable by negative 1,600. And so I actually have an actual little report. Oh, hold on. Let me get my little clicker. On my next slide, we're going to actually have a variance cost report that helps us. And here's what it looks like. So here's my budgeted at actual productions. These are the dollar amounts. These are my actual. So anytime I'm doing a variance report on each individual one, I'm going to go across this way. So this is what I budgeted. This is what I spent. So obviously I didn't spend as much as I thought I was going to. So it is favorable by 2,900. Under power and lights, I actually spent more than I expected, unfavorable. And in direct materials, I spent less. So that's a breakdown. This is called the factory overhead cost variance budget. Down here is my fixed. Remember, fixed are going to be the same no matter what. So it's not going to be favorable, unfavorable here. So what I'm going to take a look at is obviously my favorable is this amount. My unfavorable is this amount. When I net them together, 4,200 minus 200 is going to be 4,000. So that's my controllable variance. Remember what controllable was for. Controllable is variable. And here I'm going to multiply capacity not used at a standard rate for fixed factory overhead. So this is a little different where I'm actually going to show that I basically could have made 5,000 if you remember, but I only did 4,000 direct labor hours times my rate. And so this is what I end up with. Here's kind of a little example of factory overhead. Hold on one second. Okay, So now I'm going to show you how it's all put together. My applied factory overhead, here's my standard hours for actual units produced times my rate. 4,000 direct labor hours times the 6,000 is 24,000. The total factory overhead is 22,400. So I budgeted, applied means budgeted, 24,000. My actual was 22,400. So my actual minus my budgeted. So remember that we always put actual first. So that's negative 1,600 favorable variance. This slide just basically shows in the factory overhead account whether it's how to know whether it's underapplied or overapplied. And we've had this conversation in a previous chapter, so you can take a look at this on your own. But I want to move forward to show you the most important slide. And again, I'm going to skip this one, and I'm going to skip this one. Here's what I want to show you. This is the key factor here, especially this part down here. This is my factory overhead. So this is the actual side over here. This is the applied side. So this is the budget. Applied is budgeted. And so my controllable variance, if you remember that's variable, was 4,000, which is this minus the 26,400. 22,400 minus that is 4,000, negative 4,000. Over here it's 26,400 minus 24,000. That's positive 2,400. And then I add these two numbers together to get this. So this concludes my factory overhead variances for chapter 22.